Awesome. So we've broken down some of the most important factors behind your options trading success. Now, what I want to talk about really, really quickly is about sort of like a short for options, and it's called writing options. Now, it depends on your broker if they'll let you do this naked, which is really a fun way of saying you have to own the underlying stock if you're doing it for a stock. So if I have like 100 shares of Nike, I can write a call or a put for my 100 shares, and that would be a covered call or covered put, right? So if I go over here and I look, maybe I say I have Nike, okay, and I have 100 shares. If I sell a call for maybe say the price is they're like what, 70 bucks. So if I sell a call at 75 and I tell somebody that they can buy it for me at 75 bucks, then that would be something I could sell. I could also sell a put at say 65 bucks. So somebody is allowed to sell or buy me at 65 bucks. So with a call, remember, if you're buying a call, then you're buying the ability to buy. So if you're selling a call, you're selling the ability to buy, which means you're selling somebody. So you will buy it from them. Versus a put, you're buying the ability to sell. So if you're selling a put, you're selling the ability to sell. So you're telling them you'll buy it from them. You show an example of this with Nike, right? So Nike, they're what, like a $90 stock right now. So if they're at 90 bucks and you own 100 shares, what's really cool. Remember, with traditional calls and puts, right? A call gives you the ability to buy at strike, and a put gives you the ability to sell at strike when you buy a call or a put, right? When you buy. So when you write an option or when you sell an option, like with Nike, if you own 100 shares in Nike and you want to sell an option, so you could sell a call, right? You sell a call, and what that does is it actually brings you into the marketplace and you'll meet somebody. So somebody over here wants to buy a call and you could sell them that call. So with Nike, your call would be above the actual current price, the spot price. So for $90, maybe it would be like $95, right? And so you could sell a call, you would collect the premium that this buyer pays, and that premium, if it was like $4, you collect $4, right? And then they would pay you $4 a share to control 100 shares. That's 400 bucks for a set period of time, and they'll have the ability to buy Nike from you at $95, no matter what Nike goes to. So if Nike goes to $150, you have to sell it to them at $95. If Nike goes to $40, the option expires worthless, right? And you get to keep the premium they paid, so maybe like $5 on the $95 stock, something like that. Less dramatically, if you're on the buying end of this and you want the price to go up, this person who's selling thinks that the price is actually just going to chill out and trend down or go sideways. And the goal here, when you own it and when you're actually writing this option, is to just take income from your investments. This is a very, very powerful way, especially if you're a long-term investor, to turn your passive assets that aren't really doing anything into passive income. So you could write a call or you could write a put. You write a put maybe at like $85. So remember, writing a put, somebody buys it from you for a premium, and they're buying the ability to sell the stock at $85. So they think it's going to go down. So if you're writing a put, you probably think it's going to go sideways or it's going to go up. When you sell a put, you're guaranteeing that you will buy this Nike stock at $85. So if Nike goes to 80 bucks, you're still going to buy it at 85. If Nike goes to 90 bucks, it will expire worthless because the strike price is below and it's a put, right? And so what this does is really, really interesting. If you look at the actual profit curve on this for you as a seller, as a writer of these options, what happens is you have a very nice limited upside, but you sort of have kind of like an unlimited downside. So you have to be kind of careful with this and make sure that you use strong predictions or strong technical analysis. For example, when you're writing a call, all right, and the stock price is at like $95, you're giving somebody the ability to buy it for you if the price goes up. So you're taking in, this is the amount paid, right? Yeah, or $90, my bad. So yeah, $90 here, and then this would be like $95, and you're taking in like $4 to actually control this option. Does that make sense? Is that cool? So this is the premium that you're getting, and this is the price that it was currently at, right? And so if the stock goes down, you actually get a little bit of a buffer zone because you sold this option. But if the stock goes up, you're capped. So your gains are capped, and your losses would just be like if you were normally holding the stock. Your losses are going to go down as long as the stock goes down. And this brings into question what's called a naked option. And I'll write it in blue because it's kind of important. Naked. So some brokers will let you do this, some brokers they won't let you do this. You got to check with them, see what's up. This is why I'm constantly updating kind of my broker page where I recommend like the best brokers that I know of. With a naked option, you're allowed to sell an option without actually owning the underlying asset. So, for instance, with this Nike example, you would be able to take this income right here by selling an option, even if you don't actually own the underlying asset. What's that mean? Well, it means that if the option expires worthless, you don't actually have a loss. You just get to take in the profit from the premium that was paid at market price. Versus using this premium as a way to sort of buffer an investment that you already have. It's called a covered call, right? It's this idea that you can create passive income by selling the options premium at market so that you get this little chunk of change and you have a capped upside, but you don't really think the stock's going to go up that much anyway, so it's not a huge deal. And this is a really, really, really great way to make money in a sideways market, is you just take your long positions and you sell a bunch of options on them for a set period of time where you don't actually think, based on the technical analysis, it's going to go above a certain price. I mean, it doesn't have to be this close to the spot price. You could sell up here for maybe a smaller amount of money. And I know a lot of people that do this, right? The only thing with it is it sort of traps you in that position if you're not allowed to have a naked option written out. So if you write a call or a put for your 100 shares, you're using your 100 shares as collateral in case the person wants to buy or sell from you in the chance that they execute the option. If the option expires in the money or is at any point during the period in the time range, it's in the money, right? They make money on it and they say they want to take their profits. And you've got to kind of pay out of your pocket a little bit. It depends on the position, right? So with a covered call, all you're really doing is selling it below market, but you're still selling it at a premium to what you originally owned it at. With a protective put, see that's a different situation. We'll get to that in just a moment. But it's the same idea, right? If somebody's buying the ability to sell, means they're selling it to you. So if the market's at $80 and they're selling it to you at $85, you're losing out just a little bit, but at the same time, if you're like a long-term investor, it's like cool, right? Because you are buying at a discount and you think it's going to keep going up and up. So that would be sort of like the covered call. This is the example where you have just a little bit of investment income that comes in from your selling of the options premium, and if you actually own it, if it's a covered call, right, not naked, if it's covered, you own the underlying stock, you own the 100 shares of Nike, then you are going to have this downside. If the stock goes down, then you'll lose your money, but you have this little buffer zone, so you make your profit. And if you're holding it for the long term and it goes down, it goes up, and it goes down, it goes up, it goes down, it goes up, you keep doing this over and over and over, here, wherever, based on technical analysis, right? So that you can sell your option and it expires worthless. You can sell your option, it expires worthless, and you're making pretty solid. I mean, I know a lot of people that make like 6, 7, 8, 10%. Very, very, very passively just by using this simple strategy, and they do it maybe for about 10, 15 minutes a month, and bam, all you do is the same thing over and over and over. When you see the right technical setup on the right stock that you're already invested in, it's like basically using your skills in investing to create your own dividends based on what people are willing to pay to speculate on the options price of a given asset. This is very, very, very effective for those higher price stocks that are more influenced by market performance and aren't really going to be high flyers on their own, like maybe some tech stocks would be. Next example, they're a little more chilled out compared to something like Nvidia, AMD, where these are a little bit more actively traded and they're a little more volatile. And that's why if you do actually go and sell and write your options in these more volatile investments, you're obviously going to get paid more because you're incurring a greater risk to be in this market. And that's what we talked about earlier with this idea that there's a time value of an option. There's obviously also the expected volatility value of the option. So increased volatility means you deserve to be paid more for that options premium. And again, that options premium is nothing more than the actual price of the option. So same thing if we look at a protective put example. So say we own our 100 shares of Nike, okay, and we want to sell a protective put to generate a little bit of income. So we own it at 90 bucks, and here's like 85 bucks. So with this protective put, obviously we're going into the marketplace and we're saying, look, we're gonna let somebody sell it to us at $85 if they desire to. Now, obviously, if the stock price is 90 bucks, they're not going to sell it to us at $85. So with this investment, you would actually have a nice little profit at the beginning, and then as the stock price goes down, obviously if they execute it, then this profit would disappear. And then as it goes down and down and down, you're locking in profit here. But if it gets to that strike price at $85 and it goes lower and lower and lower, you are going to be obligated to buy at $85, even if the stock's 80 bucks. So you have this initial profit zone right here, and if the price goes down a lot, then you will get to pay out your butt. So you want to make sure you know what you're doing here. It's a nice way to guarantee profit. And also, if you already own the underlying company, or if you want to buy more of the underlying company, because remember, you're buying the stock. You're going to buy it from the guy if he executes it, if it actually becomes in the money. This is really just a great way to keep accumulating shares and also getting paid to do it by getting a little bit of a premium. And if the stock doesn't drop, then you just get to keep this extra cash at the beginning, which is super, super cool. Another really cool variation of this, this is not a protected put. This is the just selling, just writing a put. But a cool thing you can do if you're investing, for the long term, and you're kind of worried about temporary declines in the market, is you can actually buy a put. So this is kind of one of the last places where we're going to look at actually owning the underlying stock and then using options as a way to increase the ability for you to kind of stimulate that position and grow with that position. Writing options, this is just buying options, which is pretty powerful, but it's a different idea. So this plan, right, if you own the stock at 90 bucks and you want it to go to like 100, but you're a little worried that, it drops to like 80, what you can do is actually pretty freaking cool is, you can just buy a put at 80 bucks. So if it drops below $80, then you're going to be able to sell it at $80 no matter what, right? So it doesn't matter. You have a limited downside, and then you have an unlimited upside, right? Because if it just goes up and up and up and up, then obviously this put is going to expire worthless, but the actual price of your assets are going to increase. And so when the price of the assets increase, you make money that way. And since these puts are usually, a couple of dollars for like $100 stock, or they're not very expensive, it's a nice way to limit that downside and increase your security in a position while also maintaining your upside in a long position so you can actually own the underlying company. This is a pretty nice strategy you can use if you're worried that earnings are going to suck. Just buy yourself a protected put and pay a couple bucks at market. And it's a great alternative to just selling half your position because you had a fear or something like that based on volatility after an earnings report, which is pretty freaking cool. So with that said, what I want to get into a little bit more now is actually naked options, because this is where a majority of trading happens and where most of my profits are personally made. Because you got to remember, with longer term investments where you have the ability to sort of buy, and they're a little bit tougher to predict than swing trades or active trades. And because of that, you're not really leveraging options, you're just kind of using them as a tool to either minimize your risk or generate income. And I love, 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 love selling calls to generate income. That's a very, very good way to generate income from your assets. I don't know if I can stress that enough. I can do a whole little module on that. I mean, guys, think about this, right? If you have a stock and it's just kind of like, it's a reliable blue chip, normal company, goes up, it goes down. Maybe it's an index, right? Maybe it's the QQQ index and it's like the NASDAQ 100, goes up, it goes down. Like you can sell a call here and it'll probably never get here in this time span, but you can still collect, a little bit of income from this, and this is just cash in your pocket. This is like something that a lot of new investors totally ignore when they could be creating just a little bit extra return from their investments by capping their upside and selling a call on options. Now, obviously, this is on a case-by-case basis, but if you have a stock, maybe based on a technical setup or just based off historic performance, isn't performing very volatile. Remember, you have options here. You can sell a call here, 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 you can sell a call here. And you can sell a call anywhere you want at any price. And obviously these are going to be worth a little bit more than the ones that are sold all the way up here. But you're still getting free money by selling this call. And again, remember, it just limits your upside and forces you to sell if it does actually go above that price level. So you want to think about historically if it'll do that. Obviously, there are risks to this, right? Remember we talked about text instruments, and the people that bought those calls, they made a lot of money. The people that sold those calls, they kind of missed out on a lot of money. They missed out on like 20%. So you want to do this smart, and it's more effective with indices, especially with like short-term movements, because indices, they're not going to move 10% a day a vast majority of the time. So because of that, this is a really, really powerful strategy to use, like with ETFs, which we talk about at 9 to noon. It's just a big collection of stocks. It's really cool stuff. You can sell options and then just generate passive income by doing that. All right, so that's the power of selling calls to create passive income from your long positions in the market. Really, really great strategy, and I hope you take this, like, pause this video and like do this, okay? If you don't have any investments yet, write it down somewhere that you can sell calls to create income. Now, don't get stuck in a position because that would suck, okay? I know a lot of people, they freaked out, and you freak out after a stock has a really, really big drop, and it sucks because it messes up their whole portfolio balancing based on, when you have this call, a lot of times you really can't have a naked version of it, so you have to actually hold the underlying stock. I know some people, right, and what happens is the stock goes up and up and up and up and up, and then it goes down, and you freak out and sell call here to create a little bit of income. But now you're kind of limiting your upside. So don't sell it as a reactive mechanism. You don't want to be reactive, but rather you want to have this as part of your like portfolio management strategy. You want to be proactive with this, all right? So proactive means that once you start to approach this new high, once you're really, really pushing the boundaries, that's when you really want to sell this call to get the most value you can from it and maximize the extra revenue that you get from just holding this stock anyway. And that's a really, really, that is so powerful. This alone can increase your returns 10, 15% a year just by doing it month after month, selling, and selling these call options. A very, very powerful strategy. And if you want to minimize sort of the investment time that you put into your portfolio, just apply this to your overarching long-term portfolio, specifically like indices or really, really stable companies, and just find the ones that you know are probably going to go sideways or down for the next month, and then just write calls. And the worst that's going to happen is you're going to sell into an uptrend, and it'll probably come back down anyway, so you can average your costs out and just get paid cash money to have these options written, okay? Is that awesome? Does that make sense? Is that cool? You guys got that? All right, sweet. So with that said, I'm going to erase this, and I want to talk a little bit more about the mentality behind a protective put, just because I want you guys to understand sort of why you probably sort of kind of have to like make a decision. And it's interesting because this setup, it relates a lot to some of the straddle setups we're going to look at soon, some of the butterfly setups, some of the iron condor setups. A lot of the more complex options trading setups, they all kind of come down to the same mentality. And the mentality is you're limiting your downside and you're giving yourself a ton of upside. But you're paying a little bit of a premium for this, right? And that would be like the options premium you would pay to buy a put when you own the stock. So it'd be like a protected put. So it protects your downside, but you have upside. And this is cool. This is really, really great for obviously protecting yourself like earnings or volatile times like that. But what I want to ask you is, would you rather like guess and hope it doesn't go down and then pay a premium in case it does go down? Or what if you could just, make a decision on what you think the stock will do. And if you think it's going to go up, you just hold it. If you think it's going to go down, you're worried about it going down, you just set a stop loss. I see a lot of people, and they waste a lot of money buying these protected puts. And I think that money, for a vast majority of investors, can be better used just investing in naked options. They can have just like straight returns, and then leaving their standard investments alone, especially with like a long-term investment. If you're worried about a short-term decline, and you're gonna hold a stock for 10 years, like it doesn't really matter. So there's definitely a place and a time to apply protected puts. But in all reality, you kind of need to make a decision and try to base that decision on like technical analysis, right? You want to use technical analysis, obviously, but you really do need to say, do the indicators look like it's going to go up or is it going to go down? And then make a decision and stick to that decision. The instant you do that, it's going to skyrocket your output because all of a sudden you're able to stick with your basis, your gut. You're able to stick with your thoughts and your mind because you've put in the work, you've put in the strategy, and you understand how to analyze a stock. And that comes through technical analysis, looking at the chart, looking at the fundamentals, and saying, look, I think this stock's going to go up or down, and then put your bet on if it's going to go up or down. And if you don't have a solid bet, don't make a bet. Only take the trades that are going to win. You want to know how to make more money in the market, don't take the losing trades. I mean, it's very, 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 very simple. Stop losing money in trades that suck and only invest in trades that are really, really good, that you think are really, really good. And then you'll do really well, right? That's the point. Predictive put, I mean, you could use it as an alternative to a stop loss or a risk reward setup, but in a vast majority of situations, you'll see traders that are indecisive use protective puts, at least in the short term, when they're worried about short-term gain or short-term loss. They're not focused on that long-term gain if they're in their overarching portfolios. And this is basically never used for 9 to noon trading because stuff just happens too quickly to get options put in on top of actually buying the underlying stock. I mean, it's just very, very rare to happen. And I'll get into this a little bit more right now, right before we go into naked options, because it's an important concept. And it's kind of one of the last things I want to go into before we actually get into naked options, which are really powerful. And it's using options, naked options, covered calls, printed puts, but mostly naked options in 9 to noon trades. Now, this is a pretty interesting topic because not a lot of people use options for 9 to noon trades. And the reason is it's just really, really tough. So let me give you guys an example, okay? This stock, I don't know, it's like $7 here, and it's going to like $12, okay? And it's going up and up and up and up, and then you have like an ABCD setup, okay? Now, with a lot of options, you've got your strike price, right? And with 9 to noon stocks, because these are usually smaller stocks, smaller companies, if they have options, they're usually pretty spread out. So like more volume, more liquidity, more demand. Like with Nike, they have a lot of options prices, a lot of strike prices because there are a lot of people that are trying to buy Nike. So it makes sense for them to have a lot of options in the marketplace. But for these smaller stocks, you might have like one option here at $10, maybe like one here at $7.50 and one here at 12. And so because of that, you have a really, really, really spread out price range. And if you look at like when you're actually trading 9 to noon stocks, this is usually going, and this is what we talk about obviously with stock screeners. This is usually going to have like a pre-market gain, and then the pre-market gain is going to spike up the volatility, and that volatility is obviously going to like drastically increase the perceived value of the options because they have more inherent value from the gain, and then more importantly is their expected volatility just skyrockets, so their value really, really pumps up high as the increased volatility obviously increases your time value. So really important concept, and it's something that happens on your stocks. So what you'll see is like if you've got an ABCD set up here, right? A, B, C, and then D. Okay. Now your target on this maybe it's like $12, and you're getting in at like maybe 9.20. Okay. You might have an option here at like $10 with maybe a $3 premium or I don't know, that's pretty reasonable, right? Like maybe a 180 premium, okay, and it breaks even at 12.8 or 11.8, okay, with a $1.80 premium, okay. Now with this position, your upside here is usually probably 13 bucks, just based on standard ABCD setup. But your downside is you probably set a stop loss right about here at 758.8/750. Whatever this price level here is below the C, pretty conservative price level. And you would really want to get in right about here when it's making that new high, right about here, and you would ride it up. Again, double. You just take this run up, add it on top. It's about a $13 target for this, example. So the downside is it goes to 750. Now, if you get in at 9 bucks, you lose a dollar. You're risking a dollar to make $3-4. That's pretty freaking good. That's an awesome little trade right there. Now think about it if you put in, it's like a $2 option, and the option breaks even at 12, right? And then your high side is like 13 bucks. So putting in $2 instead of $9, which is pretty nice. But you gotta remember, if this thing goes to 8 bucks, you're only gonna lose a dollar on the stock. But on the option, and especially if it's a shorter term option like a week, which is what you would trade, because obviously you're only going to hold this for the rest of the day. So if you're only going to hold it for the rest of the day, then it makes sense to trade the lowest time period option, because the lowest time period option is going to have the lowest time value and therefore the lowest price to buy the premium to actually have the option, right? So if this option goes from, the price goes from 9 bucks to 8, but then instead of going up, it kind of dies down. Well, now you're going to get a little bit of a huge freaking problem, because this is going to react very, very much more than just a normal price would. This is going to decline in value drastically faster than the traditional price. Now, that would be a problem if the upside was a lot bigger, but think about it like this, right? Your target is 13 bucks, your break even's a little bit under 12 at 11.80. You break even, and then you have like, what, a dollar up? So you're risking $2 to make $1. I mean, that's a bad trade, right? You wouldn't make that trade. You want to risk $1 to make $3. And so a lot of times with these shorter term options, you'll get into situations like that, and specifically with 9 to noon trades, where it just makes more sense to trade the stock. Because you got to remember, if you're trying to trade the option here, you're going to face a pretty crazy spread. I mean, this probably have about a 5%, 7% spread. And because of that spread, it's going to be a lot more difficult to get in and get out quickly. And you need to get in and out quickly of these trades, because it might be at this high point for about 1 minute and then just like die off for the rest of the day. You just don't know. And if you can't get out quick at this break-even point or above, you're freaking screwed. And if it goes down, you're even more screwed than if you just bought the stock. Now, what's cool with swing trading and with like more long-term investing and with covered calls and puts and writing options is that like you can kind of time it and take it a little bit slower, and you're not going to lose 70% of your option value in about 5 minutes. That's not true in 9 to noon stocks. And the difference and the big problem is with the vast majority of brokers, you can't actually set a stop loss for your option very easily. It's a tough process, because remember, it's based on premium price, and premium price is constantly changing based on time value, based on inherent value, and for a vast majority of investments, you want your stop loss to be based on the price of the underlying stock. So if the underlying stock goes down and tanks, you get out. But with options, you can't really just like set a stop loss. You have to do like a conditional order, and then the conditional order at the resistance or the support that you want to sell at has to turn a traditional stock entry into an options order, and then select an options premium. But the options premium is it's calculated based on the inherent value and the time value, right? So you don't really know what the heck your options premium price is going to be at any given point in the future, and especially with longer term trades, you don't really know what this price will be for the options premium, right? The premium, you don't know. And this is why you see a lot of traders, they'll struggle, and investors, they have a tough time because they're focused on changes in the premium price instead of changes in the actual underlying asset. And what I want to show you is that through technical analysis, if you can predict whether a stock is going to go like this or like this, that's what's more important than analyzing like the time value of the option or using those Greeks that we talked about that are just total crap. Like that doesn't matter. What matters is figuring out where the stock is going to go. And when you're making direct investments and direct trades, specifically in 90 Noon stocks, like these are already extremely volatile positions, and leveraging this is very, very risky because, like I said, these are the top 1% of stocks every single day. They get about 80% of the attention, the volume. Well, not necessarily the volume, but the growth, right? You see these stocks go up hundreds of percentage points in a day. I mean, they're getting a vast majority of active management money poured into them, which is awesome. But you don't see that same growth in the actual options. The options really, really do get messed up because it's very difficult to get yourself with a solid stop. It's super tough to have a stop loss for the options. And at the same time, when you're going into the investment, this just doesn't have the same risk reward that a normal setup has. And this has so much more liquidity. Liquidity is so huge for these because you're literally in this trade for maybe 15, 20 minutes. And you need to have perfect entries and perfect exits to get out of there. And with options, you have just this much larger spread with less volume, which means you have less people in the marketplace, which means you might maybe make a little extra, but it's really, really risky, and it's tougher to get out, it's tougher to get in, and it's very, very difficult to cut your losses. And on top of all of that, you gotta remember that you're gonna absolutely crush this if you do it right. And if you do it wrong, you're gonna lose maybe what, 3 or 4 or 5. Let's see, you're going from $9 to $8. So that's a little bit less than a little more than 10%, right? And your upside here, of course, is $3, which is a little bit more than 30%. 40% was $4, so 40%, a little bit more than that. So you've got a really, really, really nice risk-reward ratio here. But if you do this with options, the problem suddenly becomes, and here, let me draw this in orange so that it kind of stands out and you can see what I'm talking about here. This trading range right here, if the stock is in this trading range, you make no money. This is the point where you break even. This is the point where you enter the trade, and this is like everything that you're paying to be in the trade versus paying this versus paying the actual $9, $2 to get in the trade versus $9 to get in the trade. But the problem arises when your upside only starts right here, and you might only have this little bit of upside, whereas when you're in the actual trade, you've got a lot more upside even though you're putting up more capital at the beginning, okay? That makes sense, I get that. But here's the kicker, right? Your downside on a normal trade is just this little portion right here, and then you stop out. You're disciplined, you've detached emotions from your money, and you know that this is where you're getting out. But with this, like, the stock could go here, and you could stop out here, and you'd still be in the hole, a bunch of this premium, much of the time value, no profit whatsoever. And really, you're at the mercy of the small group of people that are trading options on this position actively as to whether or not you break even on it, you lose on it. Because a lot of times, you're going to see huge spikes of volume and liquidity and volatility in the morning on 90 Noon stocks, especially after this big pre-market gain, which again, we talk about in the screeners area. And so, because of that, this stuff really, like the options premiums, they spike up a lot in the morning because of the volatility. And so it's very, very, very difficult to make good trades with them because you're looking at a trade where with a vast majority of positions, you need the stock to go up a whole bunch to break even. And then it's a lot to get into it. So you have to have a substantial amount of upside when it would just make like 10 times more sense to just buy the stock if it's already going to go up that much. Remember, options are really, really, really good for multiplying, like something like Nike. Like that's kind of a smaller movement company. They might, maybe they'll move 2 or 3 or 4 or 5% in a day, maybe 15% in a month if we're lucky. That's kind of, relatively a small movement. With these stocks, they're moving hundreds of percentage points in a day. You want to use options to multiply small returns and leverage small returns. And you kind of want to stick with 9 to noon trades that just produce consistent income, consistent wins over and over and over. Because they already do extremely, extremely, extremely well. And until you master these, it really, I mean, like, I've been doing this for a pretty freaking long time, and it's still really difficult to do options on these trades, at least with the brokers I'm using right now, just because of the way the marketplace works. It's slower to get in, it's slower to get out. And this dead zone right here really drags down your profit margin and cuts you out of a lot of the upside. And it just makes so much more sense to just trade the stocks and crush it going 9 to noon. So I hope that makes sense for you guys. I hope you understand that there's a very specific application for options. And I think the best way to use them is, about 1 month to 6, 7, 8 month swing trades to multiply those returns. You got to remember, right? You're risking everything when you do an option, and especially with very, very short-term options, you can get screwed. You can get screwed pretty bad. And like what would be awesome is if you could like buy an option before the pre-market gain, but like obviously, I mean that doesn't happen. That's why you're trading the stock, is because it came up on the screeners, and that's why all the trainings I do on the screeners, because those are so important. But I mean, if this kind of like overlays the principle of like, you want to get in before the big game with the options, and that's why you would use them for earnings reports, which we'll talk about in just a little bit. So that was my rant on 9 to noon trades with options. It's something very few people talk about, just because not a lot of people actually trade 9 to noon. And then of those people that trade 9 to noon, not a lot of them trade options. So they're two very, very great skill sets to make a lot of money, and I would highly recommend you get really good at both of them, because remember, with 9 to noon, you're spending about the first 2 hours of the book. It's like chapter 1, right? Is the day, and you've got that extra like half hour, hour at the end of the day to work on swing trades. And what I've been transitioning into lately really is spending that last little bit of the trading day working towards making some really, really awesome options picks and calls that go out there and produce, triple-digit returns, which is freaking awesome percent returns. And that's a really, really good way to spend your time. So you're kind of balancing between, the immediate growth and then that kind of medium-term growth. And that's been working really, really well for me, especially now with markets being pretty high as of time recording this. It works to kind of keep you out of, the overall crap of what's going on with the economy. You kind of create your own economy where you have total control over your income, your growth, your portfolio, because you kind of understand the ways that you can manipulate the game and play it the best way possible, which is kind of like the whole goal, right, is to absolutely freaking crush it. So I hope you guys kind of see what I'm saying with that, and it'll make a whole lot more sense once you actually start trading 9 to noon. You'll start to see like, whoa, holy crap, these stocks are insane, right? And that's kind of the point with that. So, that awesome? You guys like that? That great? So, with a little bit of delay, I am glad we are finally at naked options. So this is really, really, really where you want to be. And this is the basis of all the complex setups we're going to look at soon enough. And this is just basic calls and puts. And like I said earlier, I mean, you guys know this, right? You buy a call, you buy a put. What's cool about, like if you buy a call or you buy a put, I'll do like profit, loss, okay? With these trades, if this is like $0, the most you're gonna lose is what you pay for the options premium. So you pay the premium for whatever it is, and as soon as you pay the premium, that's all you can lose. Now, if it expires worthless, that's what you're going to lose. But that's all you can lose. So you know your downside, which is really good for planning risk-reward ratios. So you know your downside. Now, what you want to look at next is the stock that you're trading, right? You want to look at like the underlying price movement of the company so that you kind of know where the price will go, right? So if this is the stock chart and this is the option chart, this is the stock chart, and you see maybe a really, really nice support line here, and we'll get into support lines more later, and a really nice support line here, it's going up and up and up and up, and then it bounces down, 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 then it goes up and up and up and up, and you want to buy a put right here, you know that you really want to see it kind of go right over here. So this is like 20 bucks. This is like 15 bucks. You got $5 here, and maybe the option costs you like $1. Okay, so you know that your profit potential here is $5. Okay, so this is your reward, and this is your risk. That's pretty sick. That's what's cool about options is you can set up these risk reward ratios based on technical analysis of the inherent value of the option, not the time value of the option, of the inherent value of the option. The time value of the option, I like to think of that as icing on the cake, okay? If I'm going to buy an option for, let's say this is a 1 year chart, okay? This is 1 year, and I'm going to buy a 6 month option just to keep my ass safe because I don't want it to expire and then I lose money. I don't want to lose money. So I'll buy a little bit more expensive option just in case it's kind of like a slow growth or if it's a slow downtrend, right? If instead of going down really quickly, it goes kind of slower and it takes a little bit longer. I'm totally cool with that. I like the money. I'll take it. But I'll definitely be a little more conservative with my time periods and give it just a little extra time. Um, and if you get really, I mean, because you just don't know what's going to happen, right? It might trend up for a bunch and then go down. So you just don't know. Um, but with this trade, it's cool because like I know that as soon as the price gets here, I'm selling my option. I'm selling my put, right? I bought the put, I'm selling the put. And I'm gonna, I'm gonna execute the option, right? That's what it's called when you want to get out of a position. So if you buy a call, you buy a put, you want to execute the option. You would execute your ability here to sell at this price that's way higher than the current price. Or if it was a call, you would execute here to buy the lower price and then sell it at market, right? So that's what happens when you realize your profit on an option, you just execute it. And again, if you have a call, you're buying, so you would buy below the market and then you would sell it at the market. Same thing with a put, you're selling above the market, so you would just buy the shares at market. And then the difference, obviously, between these two numbers is what your option will be worth in inherent value. And you can just execute it with your broker, and they will send it to the options exchange, and you'll get your money. And there you go, right? You get your money. Now, what's cool is that on top of this spread value, which is the inherent value, you're also going to get the time value. And that's freaking sick because, say this trade gets done in 3 months, it's still got 3 months of time value, right? And so the next person that buys that, they're going to pay me a little premium for this. So it's a nice little bonus that I get. But that's not the point of it, right? Like, I'm not going into this trade worrying about the time value. You shouldn't worry about the time value, but understand that if you can get a trade done quicker, like with flowers, I got that trade done very, very quickly. I got a nice, just little extra bonus on the time value. I got a little bit extra money in my pocket based on that. I'm not thinking very specifically about time value. I'm more worried about the trade reaching its destination, more worried about the trade reaching its target by the time of expiration. And then obviously it being reasonably priced per the actual trading range, which is super important, right? The biggest thing to do is to just let it work out, right? So you know where your profit target is, you know that you've already set in your risk, and you just let it go, okay? The value of this, it might decrease just a little bit over time, but what you're really looking for here is the growth in inherent value, and that's going to be this big chunk here, and then just this little chunk is your time value. And the goal, obviously, is to find technical setups that allow you to create this big chunk of growth and therefore have really solid, like 4-to-1 risk-reward ratios, which is really good. And you make that trade 10 times, you're going to crush it. And that's really the point with this. Is that you make a bunch of trades like this, and then they all do really well, at least some of them do really well, and then they have a lot more gross gains than your losses. So average gain is significantly higher than average loss. If you can do that, you can freaking crush it, and that's the point with it, which is super cool. And then again, that time value is going to help you out just a little bit to increase your profit just a little bit, which is super cool. So that's sort of the mentality behind naked options, which are really just options where you buy them, or you say you buy a put, you buy a call, and you don't own the underlying stock, so you're only trading the option. Some brokers, they require you to have like certain limitations or certain account features or certain margin requirements. Um, Again, this is why brokers are always changing. So that's why I have 90secrets.com/brokers, and then you can see kind of like what I'm recommending right now. But it's pretty stable. Is you want to find a place where you can get options without having to actually own the underlying stock. Because again, you're doing this for leverage, and you don't want to have to like buy the stock and then buy the option because that's a lot of money and that's not really leveraged at all. And then you're kind of decreasing the amount of capital that you had to invest. So that's the power of just buying calls and puts and letting them do their thing. Now, since we have this example up here, there's one concept I want to talk about before we kind of finish up with this very basic, description of calls and puts, and it's the idea of like what to do with a loser. Okay, so say this company, they're doing their best, they're really, 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 really trying, and for the first, 4 months of this trade, they just keep staying up here and up here and up here. Like, what should you do? Now, the first thing to realize is that your inherent value is basically not going to change. It's going to stay kind of where it's at. And if you're sticking at a loss and maybe your break even is right here, then you're still going to be at a loss. The time value might decrease a little bit, but it's not going to be too huge until you get really, really close to the end, right? So if this is like halfway to the end, or 3/4 of the way, like this is kind of when you would start to decrease that time value. But again, you can't lose more than you put into the premium. And the cool thing is, if the trade goes south, you can sell it at any time, which is sick. But what I want to talk about is what I've been doing and what's been working really, really well for me is, when I make these trades, I very, very carefully use technical analysis. And I'm going to talk about this so much when we break down all the patterns and setups. But I'll use technical analysis to figure out, like, how long should this trade take? And the instant I can find out how long the trade should take, that's when I might add like a month or two for safety onto the options period, and then I'll just get in, okay? And then I'll just leave it, okay? So if I make a bunch of money really quickly, I might cover it, take my profits, be super happy. But for most of the trades, I realized that like I've already put in all the money I'm going to put in, and it's either going to crush it or it won't. And I let it go and I let it go and I let it go. And if it gets halfway here and it's still kind of doing nothing, I might be a little skeptical, but I'm going to leave it until sort of that last very small sliver where the time value starts to decrease really, 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 really quickly, especially if it's out of the money and it still has like some of its value left. That's when I'm really going to start thinking about if this pattern's going to set up or if it's actually going to go up and I was wrong. And if I was wrong, you accept that you're wrong and try to get out of there and salvage it. But a lot of times you'll see it'll just kind of take a little bit longer. So with flowers, I mean, it's longer than I thought to really reverse. It might go up a little bit, but in the end, it might go to where you thought it would go on that resistance line or that support line. So sometimes you just have to give it time and be patient. And that's so true for so much of investing. I mean, if that's like one thing I couldn't really stress, I can't really stress enough is patience and just letting stuff work out. It's a very, very difficult skill to acquire, and I've gone through a lot of losses to really start to materialize my ability to just chill out with positions, because what I used to do all the time is I would cut a position and then would freaking crush it the day after for the next 2 weeks. And like there was no reason I cut the position, right? Like it's not like it was at a big loss. It just wasn't moving fast enough for me. And so that's a paradigm I want to challenge you today. I want you to think like when you're going to exit a position. Logically, why are you exiting a position? Is it because you're bored of it? Or is it because like your money's locked up for too long and you need to put it elsewhere? Because a lot of time, if you're positioned for like less than a year specifically, and it's like a swing trade or a long-term investment, and you just decide to cut out for no reason, you're gonna start to see like you can get messed up pretty quickly. We talk about this a lot more in the book, and we can look at it with indicators. But like if you have Bollinger Bands, the Bollinger Bands are usually pretty wide. But when they start to tighten together is when the stock price isn't really moving that much. And when the Bollinger Bands tighten together, that's when you start to see the price really, really break out of the Bollinger Bands. Okay, and that's a pretty powerful concept. This idea that you have the most volatility after a period of condensed rest. And so sometimes you just kind of have to chill out and let it work. And I've had it happen so many times where I just decided to, and it's even happened with 9 to noon trades. I would literally say, look, let me just chill out for 30 seconds. Let's see what happens. Sit there, relax, breathe in, breathe out, and you just let it happen. And then lo and behold, you're up 15, 25% because you just chilled out and didn't cut a stop for absolutely no reason. I'm not saying don't have a stop loss, have a stop loss, but if you don't hit your stop loss and it's not moving fast enough, like maybe just chill out and let it do its thing. That's especially true for some of these options trades where you really do have a lot of money on the line, or at least a lot of risk, right? Because you're risking everything, and so you just kind of have to let it work out and not be too greedy when you do get those really nice profits. That's an important concept, and it's really cool because as soon as you master that, as soon as you have total and complete conviction and belief that your stocks, your positions, your investments, your trades will work out, you're going to magnetically attract them to work out in your life and create massive, massive levels of success and influx of growth. Very powerful concept, and it all stems from your internal belief, internal growth, internal ability to absolutely crush it. So, really powerful concept here, guys. Super excited to now you guys know options and you know the basics, calls, puts, cool, and important stuff, and now you can use them to really create your own stylized trading system, which is absolutely phenomenal. And I hope this is kind of cleared up. I know at the first half of chapter 21, which is all about options, tells a whole lot about this. But these are kind of like tough investment vehicles. So hopefully this cleared up any questions you had and gave you some really actionable steps to take to have massive, massive growth in your portfolios and help you understand the number one way to kind of leverage your swing trades and just multiply your upside while still limiting your downside and radically outperforming 99% of other investors. So super awesome stuff, guys. Hope you got a ton of value from this module. Go out there, apply it, and absolutely crush it. Thank you so much, and I will see you in the next module. Bye.